Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading week ending February 3rd, 2023. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is, do you want to jump into the markets or do you want to jump out of the markets? If you're not in the markets, you're probably really ticked off that you didn't play in the January up move. If you're out of the markets and you missed it, then the temptation is to jump in. So there's a little bit of a conundrum going on right now. What I want to do is just go take a look at where we've been and where I think we could be going here in the month of February. If we look at the current markets, you can see only the Dow was in the red, but just barely, but everybody's solidly in the green. And if you look at the year-to-date performance, Dow's bringing up the rear. Of course, it had the best performance last year. And the best performance through pretty much month of January is NASDAQ, with Russell coming in 2 and then S&P number 3. You can see the best performer for the sector was communication services, and it was the best performing sector for the year to date, or at least for the month of January. And by the way, both those two, the communication services was the worst performing sector for 2022. And then if you look at energy, it was the worst performer for the week. For the year, it's utilities, again, just for the month of January. So we're still, at least through the first few days of February, seeing the outperformance of the worst performers last year, and those that did fairly well are not doing so well thus far. But I do believe this dynamic will change. If you look at the PE ratio, the forward PE is almost equal to the trailing. I remember when the trailing was a good 15, 20% higher than the forward. Remember, the forward is what market expectation is. A little over 18.5. Again, I think that's a little bit too strong given where we are. Dividend yield 1.65%. 10-year treasuries came in closing out the week at 3.38%. So the 10-year treasury is about 173 basis points higher than the dividend yield. However, the earnings yield for the S&P is at 5.45%. That's using an earnings per share estimate for the next 12 months of 226. The yield of the S&P over the 10-year treasury is 2%, but when you throw in inflation, it's still in a negative minus 1.05. And the VIX came down, let's just call it flat for the week. It came down 1 basis point, but essentially flat, closing the week out at 18.33. Okay. Most of the major indexes, as I said, are doing very, very strong here in the U.S., pretty much internationally as well. We did get Thursday, we get the S&P, we did see on the SPX, which is a cash index. The 50 moved over the 200. That was the first time in a couple of years, 2.5 years, that we've got that. So that'll change some of the algos that are firing off. Hang on just 1 second, guys. Got to clear my throat. Let me just try this out right here like this. Hang on a minute. Sorry, guys, I'm back with you now. But if we look at this, we got the 50 over the 200, so the algos will fire off differently. And I will point out, when I talked about the PE ratio catching up with the trailing, the PE ratio has fallen over 31% since last year. Although since our October lows last year, it has moved up from 15 to 18. But I still think that's too optimistic. Okay. Also, if we look at it, we're getting roughly about 33% of the S&P companies hitting their earnings, and they're missing generally both top and bottom line, although the market should never know. The markets are still, they want to just come in with a very strong rally off those October lows. And we did get economic data Friday, the jobs report. I mean, we got unemployment coming in at 3.4%. That's the lowest level since 1969 here in the U.S. Non-farm payrolls, 517,000. So that was moved the markets down on Friday. Okay. So we've got a number of those things going on. And then, of course, how can you not talk about the week without talking about the Fed and Boom Boom Powell at his press conference? They raised their rates. Markets were expecting it at 25 basis points. But the tone that Boom Boom Powell had basically put the markets on a very strong bullish support. Okay, the markets are in a battle right now with the Feds. The markets believe the Feds are not only going to pause, but be forced to cut rates in Q4 this year. The Feds believe that they're not going to cut rates this year. So we're going to see a little bit of a divergence here. And then I would think in the next 60 days, 60 to 90 days, that will become more clear with the economic data coming out and what the Feds are going to want to do. But again, Boom Boom Powell's tone was, very supportive, I believe, of the bullish market. Now, the target range of the interest rates right now is 4.5 to 4.75%. But with those ugly job numbers coming out on Friday, meaning they were very ugly for price action, very good for very strong labor market, that puts the Feds in the position of having to be a little bit more aggressive in hiking rates. So markets are expecting another 25 basis point rate hike in March, and they're raising the ante for a rate hike in May. There's not a meeting in April, but there will be in May. So the Feds want to take it over 5%. The markets, I think, have a terminal rate before the pause and then a reduction at 4.5% or below. Okay, so we'll see how that plays out. Meanwhile, if we go over across the pond and look at the European markets, you're going to see here everybody was in the green for the week year to date, very strong, doing very well. And over the ECB, just like the Feds, their ECB is trying to play catch up. They raised their rates 50 basis points, taking their deposit rate to 2.5%. Not even less than half of where right at about half of where our current rate is. But they expect to raise the rates in March another 50 basis points. So they're trying to play catch up here, which they've had higher inflation data coming in over in Europe. I'm surprised they're playing late to the game, but they are. So their headline inflation is running at about 8.5%. That's down from 9.2 across Eurozone, but still much higher than our 6.5% roughly. Okay. Core inflation over there is still very high at over 5.2%. We did see the Eurozone economy grow about 10 basis points in the last 3 months of 2022. They were expecting to come in, but it did grow a little bit. So we'll see how that plays out as we move forward in time. But I do believe that they're on the path for a recession probably before the U.S. markets are. And then, of course, if we look at the Asian markets, you can see the Nikkei, China, and Hang Seng. The Nikkei slightly in the green, year to date over 5%, almost 5.5%. China coming off of a week-long holiday, almost flat, slightly in the red. Year to date, they're over 5%, and then Hang Seng in the red, but year to date almost 9.5%. Let's call it. On the economic front in Japan, industrial production there fell about 10 basis points. Okay. But they did see a little bit of growth in their retail sales of 3.8%. That beat expectations. Meanwhile, in China, their official PMI rose to 50.1. It was in December 47, so slightly into expansion territory. But their non-manufacturing, it came in a huge bump from 41 to 54. So both of them are above 50. So let's see how that plays out in China as they go away from their zero COVID policy. Meanwhile, the IMF raised their annual growth target for China to 5.2% this year. Their original October forecast was 4.4. But they're keeping their forecasts in 2024 at 4.5%. So China is going to get away from that decade-long growth of 6, 7, 8% and start to get a little bit more modest in their growth projections. Now, what I want to do is shift you over and let's just take a look at a couple of key asset classes here and some charts. So let me just get this over here set up like this for you guys. And let me just get this thing set up on my end over here. Let's just get this like this. Here we go. So what I'm going to do here is, let me just get the, what have we got here? Let me get this set up. Bear with me 1 minute, folks. And let's get this on the screen for you guys. Where are we here? All right. So let's get this down here. I believe right now I'm showing that you guys should be able to see the screen. So what I have on the screen here is the E-mini S&P 500 futures. And I've got it on a daily chart. And you can see here, if we move it back a little bit, you can see the intraday high was on the February 2nd, up little over 6% for the E-mini futures. You can see the 2022 opening price, the low price. So we've been off to the races, and we're bumping up against this resistance zone here. That's a fib node retracement off the all-time highs at about 0.236. Okay. I do believe we'll probably over the next 6 to 8 weeks, peel it back a little bit to the 4,000 level. I think the first level of support is going to be around 4,100. And then I think we're going to make our way back to the 4,000, perhaps 3,950 area over the next 2 months as markets digest this move off the lows here. The October lows were down here, October, November. You can see my projected low price was around 34.50. We hit 35.02, but I had a range here. Now, is the bottom already in? Well, so far, if we don't hit her into a recession, or the Feds don't put us in a recession, I do believe the bottoms are in. If not, and the Feds have to stay more aggressive with the rate hikes due to inflation staying higher for longer, then we're going to make new lows. Right now, the charts have been telling me that we're going to make new lows in 2023. But if that changes, I'll let you guys know on these weekly roundups over the weekend. So that's where we are with the E-mini S&P 500. If we come in and we take a look at NASDAQ, I mean, NASDAQ was through the roof, right? If you look at NASDAQ, you can see here it was up 17.28% intraday, again on February 2nd, and then it's pulling back. This is an index. It's just not going to be able, NASDAQ 100. It's not going to be able to maintain this for long. But what's moved this up besides the mostly short covering in tech? Okay. If I show you the FANG index, now in my FANG index, I have Microsoft, Meta or Facebook, Apple, Amazon, and Google. I don't have Netflix in here. And you can see that the intraday high was 28.84%. And we're just barely off the highs. So that's moved up the NASDAQ 100 as well as the NASDAQ index as well. Very strong. I think we're going to fill this gap in here and come back down over the course of the next 4 to 8 weeks. And we'll see. But look, the 50 is well below the 200 in the futures. Okay. If we go look at the E-minis, the S&P 500 again, you can see here the 50 crossed the 200, as I said earlier. If we look at the Dow, which is probably held up the strongest, you can see it had made this last all-time high, well, not all-time, but 2022 high was made in the middle of January. But you could see the 50 crossed the 200 well back here in 2022, the end of November. All the other indexes are just now barely doing it. NASDAQ still has a way to go. And then if we look at the Russell, you can see here in the Russell on the daily chart, the 50 has also crossed the 200. So remember, Russell's small cap. I think small cap could outperform both growth and value here near term if we do get this bump up. You can see it's up 13.49%. Now, if we do get a strong pullback in the next couple of months, which is what I believe we're going to see, it's going to help us define the bottom. We need to define the bottom so more longs can come in much more aggressively. So I don't know if this is our bottom right now. Granted, it's the low for 2023, but I think we're going to make lower lows in that, possibly challenge the 2022 low down here, and then we'll see where we go from there. Okay. If we come in here and look at volatility, you can see the VIX is sitting north of 18, but we're already been in my yellow zone, which is below 20, a lot longer than we've been since the beginning of of January of last year. So let's watch and see how we go. Also, the 50s below the 200, which is a bullish signal longer term for the VIX. Okay. And then, of course, if we come in here and look at bonds, you're going to see I still think bonds are probably going to move higher, although Friday was an ugly day for bonds. You can see here my target is up here. I've also got a resistance point at 136.18 ticks. I think bonds can move up a little bit more. It's having a little bit of a hard time getting over the 200 EMA. And if we look at the 10-year interest rates, they move opposite of bonds. So you can see here on the 10-year, I said it was probably going to find support at the 200, which it has. If it breaks it, that means bonds are going to be breaking to the upside, right? I think we're going to be in a little bit of a choppy range here until we get more clarity around the Feds and just where everything is going to be, because we got some key inflation data coming out in about 10 days, or not this coming week, but the next week on a Tuesday, a CPI data, and that's going to help build this narrative of who's going to be more right, the Feds or the markets. If the markets are right, the lows are already in, and we're going to be a little bit more bullish. If the Feds are right, and inflation is going to stay higher for longer, and there is not going to be a rate cut this year, then I believe we're going to make new lows until we sort things out. So that's a little bit about what I'm seeing here. Meanwhile, the dollar, I think I even told you guys in this free weekend update to short the dollar. Friday it was strong because the markets moved up, but you could see where the dollar is between the highs and lows for 2023. But I had our members getting short the dollar back over here in early November. And it's just been a great trade. And obviously the best way to trade it is with the euro going up. And if I just switch over to the euro, you can see the euro did just the opposite of the dollar. Now I got to adjust this and move it up to the upside. But the euro had a very strong move higher here. Okay, so it's up a little bit more, and our signal to go along the euro was back over here when we finally broke the 50 EMA, and we just had members just playing this thing and making a ton of money. So if you want to participate in this, then you should join our user group because we're knocking some of these trades out of the park. Gold, that's another one that I'm bullish on, but look at Friday. It gave up the ghost. It came down hard, 53 points. It's probably, as I said, we want to buy dips on gold. Now, gold, we had to cross the 50 over the 200, which means you want to be a dip buyer instead of a rally seller. So let's see if we come back down here and consolidate and then buy. I've told our members that if we do have a harder pullback, and the dollar gets stronger, then gold is going to come down even lower. But we're going to use that for pullbacks this year. That's the way it looks. And energy is another great trading vehicle for us this year. Last year, we knocked the ball out of the park. Of course, anybody holding energy did good last year. My target last year for oil was around 67.75. We came down to 70, so we missed it by about 2.5 points or so. I think oil is going to come down and chug around down here and then probably find a little bit of support and then head higher. So that's where all the major commodity classes and bonds, treasuries, and some of the key asset classes in equities. Members, I will see you guys this Sunday evening for our weekly market watch. And as usual, if you're not a member of our group, I highly encourage you to come in. 2023 is going to be, in some respects, a stock picking year, but there's going to be some great opportunities for us. We did great last year. I think this year can be even better. All right, everybody, have a really great weekend. Members, I'll see you Sunday evening for our weekly market watch. Ciao, everybody.